The purpose of this exercise is to review adjusting entries. We are provided with an unadjusted trial balance for Beckett Rental Agency as of March 31st. In addition, we're told that there were 5 adjusting items. The first item says that equipment depreciates at a rate of $370 per month. To record the depreciation adjusting entry, we would debit depreciation expense, and we would credit accumulated depreciation equipment for 3 months worth of depreciation, which would be $370 times 3, which is $1,110. The second adjustment relates to unearned rent revenue. The company has an unadjusted balance in their unearned rent revenue of $10,760, and we're told that during the 3-month period, half of the unearned rent revenue was earned during the quarter. So, to reflect the fact that we have earned part of this unearned rent revenue, we would debit the liability account unearned rent revenue, and we would credit the revenue account rent revenue, and the amount would be for 1/2 of the balance, which is $5,380. The third adjustment relates to interest. Beckett has a note payable on its books of $2,100. During the 3-month period, we would have incurred interest expense on this note, and so we need to accrue for that at the end of the 3-month period. And so we would debit interest expense, and we would credit interest payable. And again, we're told that the amount was $440. The fourth item relates to supplies. The unadjusted balance in supplies is $3,690. And we're told that supplies on hand at the end of the period totaled $810, which means they went out and counted their supplies and that they found that they had supplies with a cost of $810 remaining. So, to determine the required amount of the adjustment, let's look at some T accounts. We were told that the unadjusted balance in supplies was $3,690. And we were also told that the balance on hand of supplies at the end of the period was $810. So to get from a beginning balance of $3,690 to an ending balance of $810, we would need an adjustment of $2,880. So we would credit supplies for $2,880, and we would debit supplies expense for $2,880. So now let's go back and record that adjustment. So in order to reflect a use of supplies, we would debit supplies expense. And to record the amount of the supplies used up, we would credit supplies. And again, using the T accounts, we determined that the amount of supplies that we used was $2,880. Finally, our last adjustment relates to insurance. We're told that insurance expires at a rate of $280 a month. Beckett has a balance in their prepaid insurance account of $2,520. And so to reflect the fact that part of that prepaid insurance has been used up, we will debit insurance expense. And we will credit prepaid insurance. And the amount would be 3 months worth, so that would be $840. So that concludes our 5 adjusting entries for Beckett Rental Agency.